Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. As always, glad you're here. Today, we're going to talk about how donating appreciated stock to charity can save you thousands in taxes. Tax savings, everyone loves talking about saving taxes, right? So, if you're charitably inclined and you have investments in a taxable brokerage account, you might be leaving some tax savings on the table if you're not doing this particular thing we're going to talk about today. Most people, reach for their checkbook or credit card when they make charitable donations, but there's a more tax efficient strategy that could save you thousands of dollars over time, potentially. And what is that strategy? It is donating appreciated stock instead of cash. So it's not complicated, but it's surprisingly underutilized. So we're going to walk through exactly how it works, why it might be a smart move when it comes to making donations, and how it can save you taxes long term. So first, let's talk about the problem with cash donations. Maybe not a problem, but just the issue. So there's nothing wrong with donating cash to charities that you support. You're making an impact, and if you itemize deductions, you get a tax benefit. So it's a win-win, right? So here's what most people don't realize. If you donate cash, you're missing an opportunity to eliminate capital gains taxes on appreciated investments in your taxable brokerage account, if you have one. So if you have stocks, ETFs, or mutual funds sitting in a brokerage account that you have that have increased in value, you're eventually going to pay capital gains taxes on those investments when you sell them, maybe when you're rebalancing or when you're in retirement using it for income. Ultimately, the IRS wants their cut of those capital gains. So this is obviously not desirable, paying taxes, obviously, but you can sidestep that by donating those securities to charity instead. So, quick note here, whenever we use the term stock, um, make an assumption that that means stocks, ETFs, mutual funds, or some other type of security. So, I may say stock, but it could be, like I said, an ETF or an index fund. So, just keep that in mind. The word stock is going to be kind of a catch all for those types of things. So let's talk about how donating stock works. So the strategy is pretty straightforward, although it does require a few extra steps compared to just making a donation directly. So let's say you're planning to donate $5,000 to your donor advised fund. We'll talk more about donor advised funds later, but let's say you've got a donor advised fund set up and you're going to donate $5,000 to it. And you're eventually going to grant that money to charities you support. But for now, you're just making the contribution to the donor advised fund. You also have a batch of stock in your brokerage account that you originally purchased for $3,000, and now it's worth $5,000. So it's grown from $3,000 to $5,000. If you were to sell that stock to free up cash, you'd owe capital gains on the $2,000 gain. At the 15% federal capital gains rate, which is pretty common for a lot of kind of middle to upper income earners, that's $300 in taxes. So what could you do instead? You could donate that stock directly from your brokerage account to your donor advised fund instead of donating cash. So here's where the tax magic happens. When you donate appreciated securities that you've held for more than a year, you avoid paying capital gains taxes on the appreciation entirely. The charity receives the full $5,000 value, and you get to deduct the full $5,000 on your tax return, assuming you itemize and the donation is under the 30% of your AGI threshold. But the benefits don't just stop there. So after you've donated the stock, you can then turn around and transfer $5,000 in cash from your bank account to your brokerage account, and then use that cash to buy new shares of the same stock you just donated. You've essentially replaced the stock you gave away. Your portfolio looks the same, but something important has changed, and that is your cost basis. So this resets your cost basis. So this is where the long-term tax savings can really start to add up over a long period of time. So the old basis on that stock was $3,000. The new cost basis is $5,000 because that's what you paid when you repurchased the shares. You've effectively wiped out $2,000 in capital gains that would have been taxable down the road. So let's fast forward a bit to see how it plays out over time. So here's the long-term impact. Imagine you hold onto that stock for several more years and it grows to $10,000 in value. And you're now ready to sell it to generate income, maybe in retirement or for something else. If you'd kept that original stock with the $3,000 cost basis and never donated it, you'd owe capital gains tax on $7,000 of growth. Again, that's $10,000 current value minus the $3,000 original purchase price. So at 15% capital gains rates, that's $1,050 in taxes. But if you had donated the original stock and then reset your basis to $5,000, you'd only owe tax on $5,000 of growth. Again, that's $10,000 of value minus the $5,000 new cost basis. And that comes out to $750 in taxes. So you've saved $300 in capital gains taxes simply by taking a few extra steps when you made your charitable donation. So not a ton of money, right? $300, not a ton, right? But multiply this over time and with larger numbers, and it really starts to make a difference. So think about the strategy applied consistently over many years across multiple donations and with different positions in your portfolio. So again, if you donate $10,000 annually using appreciated stock, each donation resets to $3,000. Resets $3,000 to $5,000 in embedded gains. You're eliminating $30,000 plus in taxable gains every decade. So that's thousands of dollars in tax savings over one decade. And then if you multiply that over multiple decades or even larger amounts, you can see how this really starts to add up and really starts to make your dollars more valuable when you actually use them in retirement because you're saving so much in taxes at that point. So it gets pretty significant over time and in larger numbers and higher capital gains brackets as well. So if you're in the 20% capital gains bracket, that makes even more of a difference. And here's what's cool. You still get the tax deduction. So you're still able to deduct the full fair market value of the donated stock, assuming you itemize and your donation is within the 30% of AGI limit for appreciated securities. So you still get the tax deduction and you wipe out those capital gains. So it's a double tax benefit you're getting. So let's go back to donor advised funds. We kind of alluded to that. I'm going to talk briefly about donor advised funds. So a donor advised fund is an ideal vehicle for implementing the strategy. And here's why it works so well. When you donate stock to your donor advised fund, the fund sells the securities with no capital gains tax liability because it's a charitable entity. The proceeds then sit in your donor advised fund account where you can invest them, let them grow tax-free until you're ready to grant the funds to specific charities. This gives you a ton of flexibility because you can make one large donation of appreciated stock to your donor advised fund, reset the basis on multiple positions, and then distribute grants to various charities over time as you see fit. So a donor advised fund is a really great kind of interim vehicle to hold these donations and then distribute them as a separate transaction. Most donor advised fund sponsors make it pretty easy to donate securities. You fill out a form, or you can even do it online sometimes, and you provide your brokerage account information and transfer those stock positions. Pretty seamless for the most part. So what qualifies as appreciated stock? So for this to work optimally, you'll need securities that meet certain criteria. So first, you must have held the securities for more than a year. Short-term capital gains don't receive the same preferential tax treatment. So you want to have securities that have appreciated in value. If you have positions that are underwater, then this is not going to make sense because it's actually better to harvest those losses in the brokerage account. Mainly, here's the big thing you have to be aware of. The securities have to be in a taxable brokerage account, not in a retirement account. The tax rules for donating from retirement accounts are completely different. So there's no capital gains issues to worry about in retirement accounts. So what securities should you donate? If you have multiple positions with gains, what should you donate first? Ideally, you want to donate securities with the largest unrealized capital gains relative to their current value. Those are the positions where you're going to get the biggest tax benefit from avoiding capital gains taxes. For example, if you have stock that's doubled in value and another that's increased by 20%, donate the one with the 100% gain first because you're eliminating a much larger tax liability. Also consider your overall portfolio strategy. If you're planning to reduce your position in a particular holding anyway, donating some of it to charity while simultaneously rebalancing can be really efficient. So let's kind of recap the step-by-step process here. First, identify the amount you want to donate and confirm you have appreciated securities in your taxable brokerage account that you've held for over a year. Then contact your donor advised fund provider and initiate the stock transfer. You'll provide the information about which securities you're donating and how many shares. Get those securities transferred, by whatever process your donor advised fund specifies. And then once the stock has been donated to your donor advised fund, transfer an equivalent amount of cash from your bank account into your brokerage account. Use that same cash to repurchase the same securities you just donated, effectively replacing what you gave away. The donor advised fund will sell the donated securities if you choose to, and the proceeds will then be available in your donor advised fund account for future grants to charities. You maintain the same portfolio allocation you had before, but with a higher cost basis on the securities you repurchase, which again wipes out those capital gains. So a few tax reporting considerations. So when tax time comes, you'll want to report the donation on your tax return if you're itemizing. Your donor advised fund will give you a documentation showing this. So be sure you get that from your donor advised fund provider. And if you donate more than $5,000 in securities, you might need to file Form 8283 with your tax return. Talk to your tax advisor about this and keep good records of the original purchase price and date. Your custodian should keep track of this, but just be aware that you want to keep track of that. And that documentation will be important when you eventually sell the new shares. So a few limitations to keep in mind. The 30% of AGI limitation on deductions for appreciated property can be restrictive if you're making very large donations. So just keep in mind, it's different than donating cash. Also, the transaction costs and timing can be a minor consideration. There might be a few days between when you donate the securities and when you can repurchase them. So the price could change, but in general, that's probably going to be a minor consideration. And of course, you have to itemize. I mean, this doesn't really work if you use standard deduction. You're not getting a benefit from it. So this works if you're itemizing deductions on your tax return. So who benefits most from this? If you have a concentrated position that you want to get out of, that can be a situation where it makes sense. Early retirees in low income years, you could actually do something a little bit different but similar. If you're in the 0% capital gains bracket, you might just do tax gain harvesting and just then donate directly. So, similar concept, but not through a donor advised fund, for example. But ultimately, in general, it's potentially valuable for anyone who makes significant charitable contributions each year, itemizes deductions, and has appreciated stock in a taxable brokerage account. That's kind of who it's really designed for. So you want to think about making this a regular practice for those benefits to kind of compound and add up over time. So when you make it a consistent part of your financial planning, as opposed to a one-time tactic, it works a lot better. So if charitable giving is already part of your financial plan, just shift to a default approach of donating securities that are appreciated in value rather than cash, because over time, that tax savings is going to add up. So identify the capital gains, use a donor advised fund, transfer and replace, and that's going to be your benefit there. So again, donating cash to charity is good. Don't stop doing that if that's what you're doing, but donating appreciated stock to charity can be even better from a tax standpoint. So it's a few extra steps, but it's, once you kind of get a routine down, it's pretty straightforward. So for charitably inclined investors with taxable brokerage accounts, it's one of the most effective tax planning strategies available. Costs you nothing in terms of actual donation amount, requires only modest additional effort, and could save you thousands of dollars in taxes over time later when you're actually using this money for income. So think about that. If you make charitable contributions and you want to save on taxes even more, which who doesn't? Everyone wants to save on taxes even more, right? So over time, the tax savings are pretty hard to ignore. So keep that in mind. All right. As always, please feel free to reach out if you have questions. My website is elevationfinancial.com. You're welcome to give me a shout there. You can also book a free consultation on my website if you want to talk about anything on your mind or consider becoming a client. All right. Thanks, everyone, for joining me today. Have a great day. We will see you next time.